When you're right on the edge of retirement, there's one question that looms larger than just about any other question. How should my money be invested? Now, this is usually a question that starts to get answered after you've worked through the plan. At least that's the order that it should go in. And it's an important question. But, all too often, the answers that you hear about how to invest your money, this asset allocation, are very disappointingly generic. It'll say something like, well, you need to go 60-40 or maybe 50-50 if you're playing it safe. You plug in your age, answer a few risk questions, and voila, out pops a model portfolio. It's efficient, but personalized, it's not even close. These ready-made ratios might work well for large institutions trying to serve thousands of clients with a one-size-fits-all approach, but retirement isn't just a spreadsheet problem, it's a personal one. And when your income shifts from steady paychecks to strategic withdrawals, relying on generic advice can be really risky, because what's often missing from these formulas is a deep understanding of the two forces that should actually shape your investment strategy and asset allocation. So let me show you what these forces are and why they matter so much more than any prepackaged portfolio ever could. So before you even think about how you should split up your account between stocks and fixed income, you need to start with the math. In financial planning terms, this is what we call risk capacity. And simply put, risk capacity is your portfolio's ability to absorb risk without putting your future income needs in jeopardy. It's objective. It's grounded in numbers, not feelings. So how do you determine risk capacity? Well, there's a few ways to do this, but here's how we approach this here. We start by figuring out how much money you're going to need to live on in retirement. Then we look at any guaranteed sources of income you already have, like Social Security, a pension, maybe an annuity, and we subtract those from your needs, and what's left has to come from your portfolio. And that gap is what we're solving for. Now, once you know your annual withdrawal needs, the next step is to identify how much of your portfolio should be set aside to fund those withdrawals over the next few years. This is what we call your spending bucket. Now, at our firm, we recommend covering at least 5 years worth of planned retirement withdrawals in a liquidity ladder with fixed income. So things like bonds, high quality bonds, not just any bonds, short-term treasuries or CDs. And the reason we like to use 5 years is that because historically, most bear markets recover within that time. In fact, if you look at the actual data, going back to 1950, the average recovery time from market peak to full recovery, coming back up to that peak, is about 33 months or 2.8 years. So 5 years gives you a durable cushion, and it should be enough to get you through a longer than average downturn in the market and keep you from selling investments at the worst possible time. Now, to be clear, this spending bucket isn't there to generate big returns. It's there for protection. It gives you peace of mind. It allows your more aggressive, growth-oriented investments some time to rebound during that downturn without forcing you to sell them at a loss just to pay your bills and take that year's distribution. And that's how you protect your plan from sequence of returns risk, which I think is one of the most dangerous threats to your retirement income when you go out and start backtesting this in prior nasty markets. So once you've handled the math and you've built a solid floor for your plan, it's time to ask a more personal question. How much risk are you comfortable taking emotionally? Now, this is what we call risk tolerance. Now, unlike risk capacity, which is about your plan's ability to withstand losses, risk tolerance is about your ability to stay calm and stay invested when the market drops. And let's be honest, this part is a little trickier than it sounds. I like to refer to this as your freakout number. Now, that's the point at which market losses become so uncomfortable that you feel the urge to sell, even if maybe logic is telling you not to. And calling it the freakout number comes from my experience working with clients during the 2008 to 2009 financial crisis. I saw firsthand how even a well-designed plan can fall apart when someone panics. And that's why I walk people through a very specific exercise using real dollar scenarios and not just some vague percentages that are somewhat neutral and safe. And here's how that conversation usually goes. Mr. and Ms. Client, your portfolio is currently worth, let's say, $2 million in this case. Now, imagine the market takes a hit. You log in and you see your balance is down by $200,000. That's about 10%. How do you feel? Well, most people will say, well, that's not great, but I can live with that. Then I keep going. Now imagine it's down $400,000. That's about 20%. Would you want to talk to your advisor at least? Most people say, yeah, at that point, I'd certainly want to talk to someone, but I'd still be okay staying the course. I've been through that in the past many times. And then I keep pushing. So what if it's down $600,000 or $800,000? Now, that's 30 or 40% down, respectively. Then the conversation usually will start to shift some. You'll see that one spouse may start to get a slightly panicked look in their eye, and the other might dig in. And, when I ask, okay, what if your portfolio drops a full 50%? So $1 million is gone. That's where most people will hit their limit. That's their freak out number. So it's not about what you say you can tolerate on a risk tolerance questionnaire. It's about how you'd actually react when faced with real losses. And it's different for everyone. There's some people that can ride out a 50% drop because they've lived through it before, in the 2008 through 9 crisis, which is one of the measurements that I use, is finding out what did you do then. But in many cases, there wasn't nearly as much money then, or they were still working then, and it wasn't as big of a deal. Once they retire, their view on risk tolerance changes. So some people can go through a 50% drop, and others would bail out well before a 50% drop. And you know what? Neither approach is wrong. But what matters is knowing where your limit is before the market tests that limit. So once you know your risk capacity, that's what your plan is telling you that you need to have, and your risk tolerance, that's what you can emotionally handle, you need to combine the two to create a personalized allocation. So risk capacity sets the floor. It tells you the minimum amount of fixed income your plan needs to be secure. And risk tolerance sets your ceiling. It defines the maximum amount of stock exposure that you can handle emotionally. So let me give you an example. If your plan only requires 20% in fixed income to meet your income needs over the next 5 years, but your emotions tell you that you'd panic with anything more than 60% in stocks, then your actual allocation probably needs to be 60-40. Not because the math demands it or that's what the Investopedia article said, but because your psychology does, and it's based off of data about how a 60-40 portfolio can act in a negative market. Now let's flip that. Let's say that your plan could handle 80% stocks, but your freakout number is 30% in stocks. Well, look, 80% is off the table. You'd go with the more conservative number. But here's the key thing here. You can only stretch as far as the more conservative of the two allows. So you might be wondering, well, then why go through all this? Why not just pick a balance fund and call it a day? Well, here's why. If your allocation ignores your risk capacity, you could run out of money. If it ignores your risk tolerance, you could abandon your plan in a panicked market. And either way, the results are really bad. But when you respect both your risk capacity and your risk tolerance, when your plan is backed by that solid math and your emotions are accounted for, you give yourself the best chance to succeed. And that's when your allocation becomes something that you can stick with in all markets, that all-weather portfolio. Because here's the simple truth. The best portfolio is the one that you can stay invested in, not just in bull markets, but in those nasty bear markets too. And in our firm, that's how we build portfolios, not based on a questionnaire, not based on some rule of thumb, but based on you, your plan, your numbers, your mindset. And if you're ready to build a retirement plan that you can trust, one that balances logic and emotion, we'd love to help. Schedule a free retirement clarity meeting to see how we can help you align your investments with your long-term goals and your peace of mind. Now, if you're just starting to think about this transition into retirement, be sure to grab our free guide, The One Critical Portfolio Shift You Must Make Before Retirement. It's quick, it's clear, and it'll show you exactly how to adjust your strategy to protect yourself as you move from saving to spending. There's going to be a link somewhere down In the description, you'll be able to download that for free. You know, the simple truth is building the right portfolio isn't just about numbers. It's about knowing yourself. And the earlier you get that right, the better off you'll be when that next downturn comes. Thanks so much for watching.